This is Scott Becker with the Becker Private Equity Podcast. We're thrilled today to be joined by brilliant leader Matt Wolf. Matt's a leader at RSM. RSM's about the leader, if not the absolute leader, in sort of mid-market, sell-side due diligence, and just all the way throughout the entire sort of private equity spectrum of deals today. Used to be at one time lower middle market. Now they're mid-market to huge in terms of what they've accomplished in building their brands for the last 20 years. Matt, it's always a pleasure to hear from you and talk to you about what trends you're watching in the private equity world. Why don't I tee it up and just ask you, what are the things you're watching most closely currently?
Yeah, thanks for having me on, Scott. It's one thing that we're watching and we're having a lot of conversations with around is the when or will the IPO window reopen? This is particularly important in life sciences, technology, but kind of broadly, right? Not only do certain types of investors look at that as their exit strategy, but it's also sort of just a bellwether of the overall sort of macro credit capital market cycle. And we've been seeing some signs of life when it comes to IPOs, particularly in life sciences. We're still certainly on the road to recovery. But as I think the world sort of grapples with the prospect of real interest rates for the foreseeable future, deals are beginning to get repriced, expectations are beginning to get sort of reoriented to that effort. We're seeing some notable IPOs, again, particularly in life sciences, announcements, which is a very important funding mechanism for that ecosystem. And also things, like Reddit's IPO that they had announced a long time ago, they're finally moving forward with. So seeing some signs of life there, which we think is important, not only for investors who count on that as part of their investment thesis, but also I think as an indicator that investors in general, more broadly, are coming to terms with the prospect of real interest rates for longer, and we're going to see some sort of return to normalcy in capital markets.
What is fascinating about this is I see a bit of a divergence, and I'd love you to comment on this. The public markets are hitting records. I mean, just the S&P's at a new record, the NASDAQ's been at a record, the Nikkei's back to the highest it's been in literally 35 years, 34 years. The public markets are, to coin a term from back in the day, are showing a level of exuberance we've not seen in some time. The flip side, the private equity markets, we're seeing multiples a little softer. Deals that were priced at 15 to 17 a couple of years ago, I'm hearing closer to 12 to 14 today, if not lower. Part of that's the private equity deals are supported by real financing, real debt, whereas sometimes the public markets are supported by the public stockholders. So are you seeing that divergence in valuations, which is also driving people back to, for a while, private equity funds were spending so much money on deals, it made no sense for somebody to exit through the public markets or finance the public markets. Now that funding seems to be a little softer, multiples a little bit more rational, but the public markets are on fire. Any thoughts on that in terms of that divergence you're seeing in multiples or prices?
Yeah. Well, that's a fantastic question. There's a lot to unpack there, Scott. So first I'd say that, the private markets generally tend to lag the public markets in terms of multiples, valuation, general swings. That's typically what we've seen throughout economic cycles for the past 40, 50 years, really as long as kind of private equity has been, or private markets have been sizable enough to really measure. So there's one sort of divergence, one lag there, and we're absolutely seeing that. Now, what I think is even more interesting, though, is when we talk about the public markets, like, what are we actually talking about? Are we talking about the broad spectrum of public equity markets, or are we talking about 4 or 5 companies? And we're definitely seeing divergence there between if we look at the difference between, for example, the S&P 500, which again is really those returns are really being generated by 4 companies, 4 names. We look at the returns of the S&P 500 compared to the Russell 2000 or the Russell 3000. We're at some historic or near historic divergences there, right? Because again, this story of the public equity markets, those broad-based index returns are being driven by really 4 companies at present, at least in year to date. And that creates a lot of other problems for private equity, not only because of public expectations of those IPO exits, but then also getting into capital allocation, right? Asset managers are sort of incentivized to allocate capital to the public markets because they need to show that they can beat their benchmarks. Their benchmarks are based on sort of broad measures like the S&P 500, which again are being driven right now, at least by about 4 companies. They need exposure to that, which further constrains private equity funding. And there's this sort of disconnect between the public and the private markets, public markets, however you want to define it. And it almost creates this sort of like circular effect that exacerbates some of the macro challenges that our private equity sponsors are seeing right now.
No, that's fascinating. And there was an article, because so much of the market has been driven by the Magnificent Seven, then the Magnificent Four, whatever you might call it. But then also there's recent articles that, there's a lot of volatility in individual stocks. You see some stocks getting crushed, some stocks going through the roof. But there's also a recent article I saw yesterday about more S&P stocks, not just the top 4 hitting historic highs, and you've got this elevated S&P. But your point is well taken. There's divergence there too, between the 4 to 5 huge technology names and the rest of them. Also, you've got a couple of these, GLP-1 stocks, the Eli Lillys of the world that are hitting out of the park based on weight loss drugs too. So there's a little bit of there's some other stuff there too. And then the Viking Therapeutics, exactly, it's just gone on fire as it released some studies on its, FDA studies and how well those have gone on their weight loss drugs. But so fascinating. Matt, what to expect going forward? And what is your education there? What's RSM saying about interest rate hikes? Where is that still sort of like still wait and see more than anything else?
Yeah, and we just had PCE data come out this morning that sort of further supported our call, which is first of 4 interest rate cuts that we can expect this year will start in June, not in May. And that's been our call since December, really. And the data has continued to support that. The Fed I'm sure they're looking at what's going on in both the public and the private markets. That's not really what's going to drive their decision as much as a lot of market participants hope that it would. But we're not seeing data to support a May cut, certainly no March cut. That's been off the table for some time now, even from the most kind of reluctant or hesitant investors have kind of come to terms with that over the past week or so. Interest rate cuts likely to begin in June, 100 basis points this year, and then marching back down to a prime rate of call it 3.25% in sort of by mid 25 or late 25.
Thank you. So at some point, mid 24, sometime in 24, early 25, someone has to buy longer term treasuries to lock in 4+% rates. If you've been living off the 1-year treasuries, at some point you got to move to longer, and it's very hard to judge when. But a fascinating issue. And what's so interesting is about the S&P 500 and those multiples being so high is people didn't think that would happen until interest rates came back down. But a lot of people think maybe that's priced in already, or they're not really clear on the pricing of that. Because as you're right, often the public markets have been a leading indicator of what happens with private equity multiples. And I think on the private equity side, there's more cautious waiting to see what happens with real interest rates because people pay real debt on those things. So that's fascinating.
And that is such a good point, the difference between private companies and especially the big names in the public markets and that access to capital. Right? I was without obviously naming names, working with a company where they needed $20 million of equity infusion from their sponsor to just refinance some of their debt because it had become just unsustainable, right? It was the same kind of debt every other private company come through, and with the real interest rates coming the way that they were, it became unsustainable, and they needed some sort of bridge loan to make it so they could refinance, get to an exit, all this kind of story that we've heard before. And the lead sponsor in the deal said, okay, well, here's your $20 million. Or maybe it was $30 million. We're going to rework your revolver and do all of this. But what we're going to do is you're going to give us in Class A preferred ahead of every other equity holder 20 billion shares or 30 billion, whatever the number was, right? Completely diluting and wiping out the equity. And that's just a real story, right? I mean, that's a real factor that private companies are dealing with because they don't have the same channels to access capital as the private markets or public markets, excuse me.
No, fascinating. It's real. Those are real issues. I mean, they really are. In any event, Matt, anything else you want to share with listeners today that's top of mind?
Yeah, I think this is a really good discussion, good summary, right? We're waiting for sort of the capital markets to roll over and kind of return to a little bit more supportable of business activity. But even when it does, we're going to be in this sort of arena or environment of real interest rates for longer. That's part of what drove the Nikkei up, right? Is even Japan finally said, hey, we're done with negative interest rates for the first time in decades. We're going to have positive real interest rates that are going to create different investment decisions for sponsors, different investment and operational decisions for management teams, whether you're public or private.
No, 100%. Just fascinating to see what's going on out there. Matt Wolf, again, from RSM, thank you so much for joining us today on the Becker's Private Equity Podcast. What a pleasure to visit with you. So always, again, Matt Wolf, one of the most listened to guests regularly on the Becker's Private Equity and Business Podcast. Thank you very much.
Thank you.